UTI AMC joining in on the show right now. Karthikraj, great to have you today on ET Now. I was just chatting with a chartist about IT. And really, that's become the market, right? Because IT seems like more a valuation play right now, more a bottom-up story with fundamentals not really turning tide, but it's more about less to lose kind of a phenomena which is at play. What's your own perspective right now on the IT sector and how investors should look at it?
Aisha, like you rightly highlighted, the valuations are quite attractive. They're comparable to pre-COVID levels. Probably 21, 22, they went up significantly. In the last 2-3 years, we've seen correction in the valuations. So the valuations wise, they are quite attractive. And fundamentally, we know these are companies generating huge cash flows and they're returning majority of these cash flows to the shareholders, and governance wise, one of the best sectors. The growth last couple of years has clearly been challenging, but hopefully that should pick up in the coming quarters or in the subsequent years. So the opportunity for IT outsourcing still remains, and the Indian IT companies stand to benefit there. So to that extent, for a long-term investor, we believe current valuations are quite attractive.
Karthik, hi. Firstly, good morning. This is Harsha. Where do you sit in terms of favor within the IT pack? Is it going to be the large cap stocks, which obviously generate a lot of free cash flow? You alluded to that. Or is it in the mid cap and the small cap space where they're more agile in this environment?
Yeah, so clearly the large companies are quite big in size, and to that extent, their growth rates may not be very high from a medium to long term perspective. But the current valuations also reflect that the mid and small companies can continue to grow in double digits, and selectively some of those companies can continue, and to that extent they are trading at a premium. We would believe for higher growth, some of these mid companies do look attractive, but the large also are attractive purely from a valuation perspective.
Right. Karthikraj, I wanted to also figure out, what is it that you're making of the entire consumer durables and retail segment? Because ever since the GST rationalization got announced, these are the two sectors which saw meaty rally play out. Do you think the best is behind us, or do you see a meaningful move in the quarters to come as well?
So within the consumer pack, the potential for growth is higher on the discretionary side compared to staples, from a longer term perspective, from a penetration level, and looking at urbanization, the premiumization trend, and increasing or growing upper middle class. You would believe that the discretionary space is favorable from a next 5 to 10 year perspective. From a near term, clearly the GST cuts have helped. That helps for few quarters. That is what we are seeing in the near term. Valuations for both the pack is expensive, but considering the growth opportunity, we would be inclined to look at some of these durables and retail and overall discretionary space more positively compared to staples.
What are the other pockets, Karthik, which are finding favor for you within the consumption basket?
Clearly, it's like I said, the durable space is one. This retail is something, and auto selectively. Auto is run up a lot, and a lot of these positives are already captured in. So to that extent, one has to be cautious within auto, but overall the discretionary space looks quite good from a longer term perspective.
And Karthikraj, where exactly are you seeing value at this point within the market? We are past the Q2 earnings. We're likely past the bottom in terms of the kind of growth that we've clocked, the low single-digit growth that we've clocked. We're now likely going to go upwards, and therefore, what are the sectors, pockets which come to mind in your opinion, which will lead that?
So clearly, we've already discussed about IT and consumer discretionary. Financials is other space where we would be positive, especially the private banks where the valuations are still relatively attractive compared to the longer term valuations. The fundamentals are quite strong. You don't have much of asset quality issues at this point in time. Growth did dip some time back, but it is again back to double digit at the industry level, and hopefully that should continue. Liquidity is in favor. Most of the rate cut impact by the private impact on the private banks NIMs is already in the price, and to that extent, we should see good growth from a longer term perspective, and valuations are also quite attractive.
Though overall earnings, while Q2 of course has been relatively a lot better than what one anticipated, there haven't been any such big misses in that sense. In fact, a few positive surprises. But do you sense that earnings has finally turned the tide? And are we likely to see a better performance in the second half?
Yeah, though expectations are right now for pickup in second half. The way we are looking at it, generally we compare the number of companies which have more than 10% growth year-on-year basis, and that number has been kind of coming down in the last 5-6 quarters. Thankfully, this quarter is more or less stable, and expectations are that it should pick up. Part of it, we've seen that this year, even the nominal GDP is in single digit because of a lower deflator. That also normalizes in FY27. As of now, the expectations are for a more than mid-teens kind of earnings growth in FY27, helped by probably even the nominal GDP getting into double digit. And that we believe even if at all there is some cuts, we should still see an acceleration from where we are at this point in time.
Karthik, a slightly more nuanced question because this has come through over the weekend. How would you play the new labor laws which have come through? Firstly, are they reasonably positive, very, very good for the Indian economy over the medium term to long term? Give us your sense on what that means. And second, how do you play it?
Right. No, the labor laws, I mean, as long as it is pro-business and at the same time takes care of the labor security, it is in the right direction, and that's what we are seeing initial feelers clearly. That seems to be the case. There would be different businesses which could be impacted in different ways. Some may actually benefit out of it, but overall, as long as it is pro-business and pro-labor, it is in the right direction, and we believe that's how we need to take it. I mean, not necessarily we have to play on each event, but we believe as long as it's positive for the business, it should be overall positive for the markets.
And Karthik, how do you play manufacturing as a theme? Firstly, are you bullish with regard to manufacturing? Because that could be a theme which could come into vogue if you could see a India-US trade deal go through. And if that were to happen, what would the pocket spaces be which would look attractive? For example, EMS may be a very, very strong theme, but maybe you don't find valuation comfort in that theme. So give us a sense around that.
Right. I mean, clearly, manufacturing has been an area of focus for the government as well, and that is something we need to clearly work on to create a lot of jobs. I mean, that's the opportunity that we have. We have a young workforce, and that is likely to continue for the next decade. And to that extent, we need to create a lot of jobs. Manufacturing can clearly help there. There are many sectors, right from auto, pharma, chemicals, EMS, like you highlighted. Everywhere, I mean, there could be potential for job creation. We would, from an assessment perspective, we evaluate it more from a bottom-up perspective, not necessarily from a top-down theme as to we need to have some exposure in manufacturing. On bottom-up space basis, we have exposure in most of these spaces, right, from pharma, chemicals, EMS, autos, and so on.
Right. Karthik, I also want to, throw some highlight in terms of what's happening within the global markets. And let's talk about US to begin with. A, the assumptions on which way the Fed is going to move. B, then you've got the Mag 7 profit taking, which is played out. For now, we've been decoupled and we've shown that resilience, at least in the week gone by. But what happens henceforth, and how do you think that's going to dictate the money flows into emerging markets and thereby India as well?
Yeah, clearly, Mag 7 and whether there is an AI bubble similar to probably a dot-com bubble or GFC crisis is something that has been discussed at length. We need to see that the differences, I mean, the top 7 companies are in very good health. They've generated a lot of cash flows. The incremental capex in AI, when that clearly helps or fructifies into revenues, is something that one needs to see. And to that extent, if at all there is any corrections there that could have an impact on the overall US markets and probably the global markets also. If there is a sharp correction, then probably not sure whether other markets, including India, will be completely decoupled. But if it is minor few percentages here and there, we could be having our own path. And that's where we need to be kind of cautious. But on the other hand, emerging markets today are relatively quite attractive compared to the US. And within that, when we look at India, in the last year or so, we've seen some amount of time correction, and the rupee is also depreciated. So for a foreign investor, we are relatively much more attractive compared to probably a year and a half ago. We're still slightly expensive. Maybe large caps are still better than mid and small caps. But overall, compared to September 24, today the valuations are no more so punchy. And to that extent, for the foreign investors, it may be time to relook at India as well.
Karthikraj, give us a sense of what you would absolutely avoid at this juncture. It's not like everything looks hunky-dory in every sector and not like there's valuation comfort everywhere. So what is it that you would, that's a firm avoid?
So we've seen that FMCG over the last 3-4 years, the growth has been muted, and some of that seems to be structural as well. We're not seeing many of these companies again going back to very high growth, and to that extent, probably that's a sector which is a little lower growth, high on cash flows, quality, ROC, no taking away from that. But the fact that there's still lower growth, but the valuations continue to be high is an area where reason why we would be underweight on FMCG. Similarly, power, again, the valuations have moved up significantly. Many of these utilities don't make very high ROCs or very high ROEs, being utilities. And to that extent, they had got very high multiples because of 1 or 2 years of high growth, which is kind of normalizing. And in that context, would be a little more cautious on power as well.
Right. Okay, Karthikraj, great to have you today on ET Now. Thank you so much for your time.
Thanks, Aisha.
Okay, that's the word coming in.